All right, welcome to Lesson 3, Options Trading Essentials in the Put Path 101. We're going to be getting into the basics of options trading. What are some beginner key concepts that we can help you with? So one of the things we want to get into is what is an option? So an option is a financial derivative based on an underlying. So it provides the traders the right, but not the obligation, to buy or sell an asset at a predetermined price within a specific time frame. So all of these options have an expiration date and a time frame with which the option must be executed. After that, they would expire worthless. So we also want to think about what kind of assets these are. So these would typically include stocks, ETFs, commodities, and other alternative assets that we try to trade, like real estate and bonds and, oil, Bitcoin, alternative commodities, things like that. Understanding options fundamentals is essential for successful trading and risk management strategies. And we're going to get into that in this lesson. Of options that we have are call options and put options. A call option is the right to buy the underlying asset. A put option is the right to sell the underlying asset. So you can think of puts and calls as mirror images of each other. Premium exchange. So traders pay for the premium when they buy the option, and then you receive the premium when you sell the option. So time is so important when we're talking about options trading. It's really the additional component, the fourth dimension that you start to get into that you really need to understand. So all of these options have an expiration date, and they all have a time value. And that time value decreases as you get closer to expiration. So options are obviously time-sensitive instruments. They have an expiration date. After that, it becomes worthless if it's not exercised. So the value of an option is composed of two parts. Extrinsic value is really the time value that we're talking about. Extrinsic value is the additional value based on the time remaining and the volatility of the option. Intrinsic value is the value an option has when you exercise it. So these would be what we call in the money. So as expiration approaches, extrinsic value declines. That's known as time decay. And that process accelerates as the expiration nears, which plays a critical role in many of our decision-making and our strategies. Concept of moneyness is also very important. When we talk about moneyness, we're talking about really three different categories: in the money, at the money, or out of the money. So options are classified based on their relationship of the current price to the underlying asset. So what I mean by that is if it's in the money, that means that the option has intrinsic value. It would make sense for you to exercise it. At the money means the strike price is near the current market price. So the strike price is the agreement of the option price that you bought into. The current market price is the price of the underlying that's always changing in the market. Out of the money means the option has no intrinsic value, meaning it would not make any sense to exercise it. All of our options that we trade stay out of the money, and this is how we like them. And this classification affects the pricing, the probability, and the risk characteristics, and we're going to get into that. The Greeks. So don't be scared of the Greeks. These can be as complicated or as simple as you want to make them. Ultimately, they're really just concepts that you need to understand that inform your decision making. They do help you understand how options are priced and how these variables influence the options pricing. So common measures that feed into the Black-Scholes model and that set the pricing for options are known as Greeks. And these, again, they help you understand how the options price changes under different conditions. So delta measures how an option's price changes for a $1 move in the underlying asset. It's also an approximation of probability that an option expires in the money. Gamma is measuring how quickly delta changes as the underlying price moves. So it's really a second-order derivative that's based off of delta, and gamma risk increases as expiration approaches. Theta is the measure of the time decay. So this is reflective of how much time is left until expiration. Vega is a measure of the sensitivity to changes in implied volatility. And then Rho measures the sensitivity to interest rate changes. Generally, Rho does not have a big impact. Implied volatility is one of the most important concepts in options trading. You got to understand that implied volatility really sets the expectation of future price movement. Volatility, when it's high, increases the price of the option. So typically we like to trade when volatility is high. You want to sell when it's high. So higher implied volatility increases the options premiums. Lower volatility decreases them. IV is often known as the fear gauge in the VIX. IV is going to rise during periods of uncertainty or market stress, and it falls during the calmer conditions. Volatility is the key driver of options pricing, independent of the other variables. And often, as the underlying is going down, volatility is going to go up, and vice versa. Many strategies are designed specifically to benefit from changes in volatility rather than directional movement. With the put path, we make an effort to sell the option during the week at the highest possible volatility. So what is a spread? If you've listened to me for any period of time, you've heard a lot about put credit spreads. So spread is the act of buying and selling an option at the same time. What this does is it allows you to have a risk management approach, to have protection on the long side when you buy that put. So you're going to simultaneously buy and sell these options of the same type. You can have spreads of puts, you can have spreads of calls. These have different strike prices and they have the same expiration dates. So the strategy defines maximum risk based on the width of the spread, and you're defining your potential reward, allowing the trader to engage in a systematic and a risk-managed approach that helps you to cap losses. Understanding spreads can enhance your trading strategy significantly. So you're going to buy and sell. You're going to have a distinct risk-reward profile based on what the current price of the option is and what you're selling and what you're buying in your put. When you're buying these options, what that's going to offer is a limit on your risk and protection against severe losses. It's also going to potentially cap your large rewards. But since we have high frequent trades, we're going to allow ourselves to have small wins with a high percentage, 85% of the time. So those small wins are going to add up. When we sell options, that is going to provide immediate premium income. So a put credit spread puts money directly into your account. What we rely on is time decay to expire before the underlying breaches our strike price. And we're going to go through all that in detail in future lessons. So what are some of the benefits to credit spreads and put credit spreads specifically? So what we look at is income generation. When you open a position, you are going to get credited the amount in your account when you open it. It's a big benefit. You get the premium right away. Limited risk is another benefit. So when we talk about the width of the spread, you're able to control your max loss. You're able to control the amount that you are risking at one time on that specific spread. And that's defined by your strike prices. So those could be $1 wide, $5 wide, $10 wide, but you control the risk. And then it's market neutral to a certain extent. So the way that we trade far out of the money. We have positions that are about 85% probability of profit. So the stock can go up, it can stay the same, it can actually go down quite a bit, and you can still win on that position. So we are basically market neutral. We have, of course, a slight bullish assumption. So with debit spreads, you have a different set of benefits and characteristics. You do have to pay a premium up front to enter into the trade. So that's why they call it a debit, because you are paying money. It's really a directional view in that you have a bullish or a bearish assumption or an expectation, and that's how you make your money. And then also you have a max loss that's restricted to the amount of the debit that you paid. So you can lose all of that. So really the most important thing to know about debit spreads is that a debit spread pays upfront for a defined risk, directional move, and it profits if the underlying moves towards your target. For your credit spread, you're looking for income direct into your account through premium. For debit spread, you're looking for a directional play that's going to go in the favor of your assumption. So risk is a key concept. We're going to touch on it real quick, and we're going to go into it a lot more later in the course. But basically, what you want to understand is that your credit spread is going to define your maximum loss, which is really going to limit that uncontrolled, naked risk that's out there. Also, you got to understand assignment risk. So if you get assigned as a put seller, you're going to have to come up with 100 shares of the underlying, which can deeply impact the capital that's available in your account. You have an obligation to buy those shares, and it can be potentially very expensive to hold those shares. And then volatility impact or volatility risk. So market changes can affect options pricing and values significantly. Changes in volatility directly cause changes in options pricing. When volatility increases, the prices of your options increase, and vice versa. When volatility goes down, the prices of your options go down as well. So the basics about assignment and exercising. So when you exercise an option that you bought, that means that you're going to have to make the seller fulfill their obligation. So if you bought a put, then you can exercise that put, and then we, as the put seller, are assigned to execute the contract. So basically, the assignment occurs when that option buyer exercises their right. We have to fulfill our obligation. That process can lead to a heavy impact on your account because you're going to have to buy 100 shares of that underlying, which can seriously impact your capital available in your account. So what we tend to do is mitigate that. So we make sure that you buy back your option before it gets in the money. Options can only be assigned if they're in the money. So once they get in the money, that's when we start to get worried. We buy those back and we eliminate the assignment risk. We're also going to get into the importance of liquidity and execution of your trades, why we choose the 12 underlyings that we do, and why we have very liquid, very tradable, high volume assets with tight bid-ask spreads. It's going to ease the trading. It's going to ease your fills. It's going to make it possible for you to get that mid price and to get faster transactions and better fills, lower cost, and higher profits. We've chosen some of the most highly tradable assets as underlyings because we want to take advantage of liquidity. With liquidity, you have lower slippage. You're going to be able to get your fills right at mid price or around that. You're going to be able to minimize your losses during that negotiation between the bid and the ask. You're going to get faster fills and quicker execution so you can get back to what you're doing that day. You want fast trading outcomes. You want to be able to get into the trade efficiently and get out of the trade efficiently. You want to be able to close these trades out. You don't want to have a Roach Motel situation where you get into the trade, but you can't get out at the end because there's no buyers to close the position. We talk about managing risk a lot in this course. The ways that we do that are we have a consistent strategy, something that you can rely on for a rules-based execution, a disciplined framework. You can stick to your plan to get consistent, stable results. We also always encourage you to trade small. You want to start with lot sizes of 1. You work your way up as you get more capital, as you get more confidence, and as you understand how to manage risk and how to make sure that you're spreading it around, and also to make sure that you have emotional control. Are you trading with a good mindset? Are you able to make good decisions? Are you able to execute in a disciplined fashion? You want to stay calm during market turmoil when the volatility is going up. Everybody's got a plan until you get punched in the mouth. That's what Mike Tyson said. But we want to emphasize sticking to your plan, making sure that you're disciplined in your approach, and the market will punch you in the mouth, that's for sure. But if you have a plan, you're going to be ready. You're going to be able to close your positions out. You're going to be able to keep your emotions in check, keep your stress down, and make sure that you're successful in mitigating the risk. So if put credit spreads are so great, you may be asking yourself, why would anybody ever want to trade on the other side? Why would you ever want to buy puts? Well, that's in the power of the options. So there's all kinds of options out there. There's all kinds of reasons that people buy options. There's all kinds of reasons that people sell options, all kinds of different strategies. Options are very adaptable. They're very innovative. They're a way to hedge against risk. For example, if you have a bunch of Apple stock, you might want to buy a put so that that would mitigate and hedge against Apple going down. So your put will make money if Apple goes down, and the stock would lose money. So it offsets it. That's called hedging. So that's just one example. There's all kinds of examples of the reasons why people buy and sell calls, buy and sell puts. We're going to learn the put path options trading system, which specializes in put credit spreads, managing risk, conserving capital, and maximizing returns. Just want to leave you with a quick quote here. Trade calmly, trade mechanically, trust the process. We're very process focused here. You're going to learn more about the process. You're going to learn the who, the how, the what, the when, the why, and the where. And we're going to go through it step by step in each lesson. This lesson was really just an overview. And going forward, we're going to get into the details so that you can learn how to execute confidently.